All right, we're looking at the U.S. market analysis dated March 6, 2026.
Just to be clear, this is a direct informational narration of the source document. There's no interpretation here.
So the big question this analysis is asking is this: why is the stock market on a knife's edge? What we're seeing in the report from March 6, 2026 is a really dangerous pattern, a mix of extreme suppression and incredibly high volatility. Okay, let's dive into the first section, a market under pressure. Now, the report tells us that all three major indices, well, they opened low and just kept trending down all day. The S&P 500 did find a little bit of tentative support at the 6,700 level, but that rebound late in the day, it was, and I quote, extremely weak. That's a pretty clear signal that bullish sentiment has just collapsed.
Now, if we look at this from a more strategic level, the document calls the market's current state compression. And this isn't just your run-of-the-mill downtrend. No, this is described as a head-on collision, a crash between a technical coiling pattern and this explosive volatility environment. I mean, the VIX is sitting near 30. With everyone running from risk, the report is very clear. The market is teetering on the edge of a structural gamma squeeze, and that's putting downside support under some serious pressure.
So let's take a look at how different sectors are performing. It's pretty telling. The only sectors leading the pack were consumer goods and energy. And that's a classic move, right? People are playing defense and trying to hedge against inflation. But on the other side of the coin, you've got 9 sectors in decline. We're talking tech, financials, healthcare, industrials, the big ones. The strategist's take here is that when you see all these core sectors failing together, it points to a systemic valuation correction. And this broad sell-off, it's pushing correlation to extreme levels, which means your traditional diversification playbook, well, it's just not working like it's supposed to.
Okay, so we've looked at the internal market dynamics. Now let's shift gears to the external pressures, which brings us to our next section, the geopolitical hurricane. The document is pretty blunt about this. The situation in the Middle East is no longer just a regional conflict. It has now become a direct pipeline for inflation.
And the report points to some serious political extremization, highlighting a direct quote. It notes President Trump's ultimatum to Iran was, and I'm quoting directly, unconditional surrender or no deal. A stance like that, as the report points out, just squeezes out any possibility for diplomatic maneuvering. It basically turns the whole blockage of the Strait of Hormuz into a zero-sum game for the entire global supply chain.
The impact on the market, it was immediate. Right after an attack on a U.S. vessel near Kuwait, WTI crude oil shot up, posting its largest single-week gain since 1990. Think about that, since 1990. So the report's conclusion is pretty stark. As long as the Strait of Hormuz isn't fully open, this structural increase in energy costs is going to hammer downstream industries through higher raw material prices.
So you have this external inflation shock hitting an economy that's already showing signs of weakness internally. And that brings us to the next section, an economy's failing health. The report doesn't mince words here. It says the February non-farm payroll data wasn't just a miss, it was a profound blow to confidence. It's revealing a very real risk that the U.S. economic engine could just stall out.
Let's look at the numbers because they really tell the story. The market consensus, what everyone was expecting, was a gain of 59,000 jobs. But what we actually got was a loss of 92,000 jobs. That's not just a miss, that is a huge deviation, and it signals some pretty significant underlying problems. And it gets worse when you dig into the revisions. Sure, the January number was revised up to 130,000, but the December data was revised down by 65,000. So what's the net result over 2 months? A revision of negative 69,000. According to the report, this is the proof right here that the so-called false prosperity of the labor market has finally been punctured.
And there are other troubling signs too. The unemployment rate climbed to 4.4%, and that's a level that starts flashing recessionary warnings. We saw major job losses in key areas like healthcare, tech, and transportation. There's one weird anomaly, though, a 9,000 job increase in the social assistance sector. The report says this just reflects a rising demand for, well, bottom-level economic support. Not a good sign. To top it all off, January retail sales fell by 0.2%, which is being blamed on consumers losing confidence and tightening their wallets.
Okay, so with all this documented economic weakness, the analysis now turns to a risk that's less visible but absolutely critical: cracks in shadow banking. What the report is arguing here is that the fragility of the underlying liquidity is finally starting to show itself.
The document walks us through a sequence of events that it calls the cockroach effect. It all started when Blue Owls slammed the brakes on redemptions from its private fund. Then, BlackRock followed suit, limiting redemptions in some of its private credit funds. That news sent BlackRock's stock down 7%. So the big conclusion here, according to the report, is that BlackRock's move is the confirmation we needed. This liquidity pressure is officially spreading from the private markets into the public ones.
All right, the analysis also gives us some specific stock valuations to look at. For Costco, the fiscal year 2026 median valuation is pegged at $655, and that's with a 13% 5-year compound annual growth rate. Looking ahead to fiscal year 2027, that valuation goes up to $717. Then we have Marvel. For fiscal year 2027, its median valuation is $84, with a medium support range sitting between 81.1 and 86.9. For its fiscal year 2028, the valuation is $117, with strong support noted down between 70.9 and 77.9.
So from valuations, the report now shifts over to the technical picture. This section is called the market's technical test, and this is being framed as a really critical emotional turning point, especially for the all-important semiconductor sector.
So get this, both NVIDIA and AMD are documented as struggling right near their 200-day moving averages. That's 176.1 for NVIDIA and 188.0 for AMD. The report literally calls these life or death lines, and here's why. A confirmed close below those levels would technically flip the entire trend from bull to bear. For the broader sector, the Philadelphia Semiconductor Index, the SOX, absolutely must hold the 329 to 312 support range. If it doesn't, we could be looking at a very long and painful recovery period.
The analysis then zooms in on one critical number for the entire market, 4.25%. Why is that number so important? Well, that's the key resistance level for the 10-year Treasury yield. The report projects that if we break above that level, it would deliver a fatal blow to high-growth, unprofitable tech stocks. It would just completely reconfigure their valuations through the discounted cash flow, or DCF model.
Okay, so the final section of this analysis ties all these factors together into what it calls the Strategist's Survival Guide. First, it notes that the VIX is near 30. That's way above the warning line of 22, and it's a crystal clear indication that big institutional money is hedging for a major downturn.
Now for the S&P 500, the report identifies one absolutely crucial level, 6,600. This is described as a strategic negative gamma acceleration zone. What that means is, if we break below this 4-month low, it would trigger hedge buyers to pull back, which would then just amplify the selling pressure. The report's downside target of 6,600 breaks, 6,100.
So, based on all this data, here are the chief strategist's recommendations. First, maintain extremely low portfolio exposure. You've got this convergence of liquidity risk, geopolitical risk, and an economic slowdown. It's just not the time to be a hero. Second, be on high alert for potential 180-degree policy reversals over the weekend. The situation is described as irrational, so anything could happen. And third, the core logic here is pretty simple. Avoid trying to bottom-fish high-growth stocks until this energy supply crisis in the Strait of Hormuz is actually resolved.
The strategist wraps it all up by saying that until we see clear signals of stability returning, restraint is the highest form of offense. And that leads to the final, thought-provoking question from the report. In a market this fragile, is staying on the sidelines the smartest move?